In this video, we're going to look at how to use the units of output method of depreciation. So with this method, depreciation is based on a certain level of output. So this would be a little bit different than the other methods that are based on the passage of time. This is strictly based on how much output there is versus how much time has passed. So when depreciation is based on the units of output method, more depreciation is going to be recognized in the periods where the assets are being used more heavily compared to other periods. So, and often the assets that are used under this method would be things like vehicles, like trucks or cars. So here we're looking at Marple Company. So consider Marple Company's delivery truck, which costs $35,000 and has an estimated salvage value of $5,000. Assume that Marple's management plans to retire this truck after it has been driven 60,000 miles. The depreciation rate per mile of operation is 50 cents, computed as follows. So to find the depreciation rate here under the units of output method, we start first with the initial cost of the asset minus the residual value. And here the residual value is $5,000. So that's the same. So we have cost minus residual value. And then we're going to divide that by the estimated units of output. So in this case, their estimated units of output is 60,000 miles. So we're going to divide that by 60,000 miles down at the bottom. So that's the estimated units of output. So at the top, we're left with 30,000, and we're going to divide that by 60,000. So we plug that into our calculators when we do 35,000 minus 5,000 divided by 60,000. That gives us 50 cents. So the depreciation here is 50 cents per mile. So 50 cents of depreciation per mile. So that's what you find first. This is how we find just the depreciation rate under the units of output method. So say for example then, we're at the end of year one. And at the end of year one, the truck was driven 15,000 miles. Well, now we're going to use the depreciation rate that we've determined to find out how much depreciation expense to record in year one for this delivery truck. So we take that 15,000 miles multiplied by the depreciation rate of 50 cents per mile to determine, okay, the depreciation expense in year one, we're going to take the 15,000 miles times 50 cents per mile, that's $7,500. So we have $7,500 of depreciation expense being recorded on this truck at the end of year one. So that's how the units of output method works. So it's not dependent on the passage of time, but it's dependent on use. So how much miles, in this case, the truck is driven each year will determine the depreciation that is recorded on that truck every single year. To finish off this video, we're just going to quickly discuss impairment of plant assets and makers. So the impairment of plant assets. So if something happens to an asset where the carrying value of the asset on the books cannot be recovered through future use, getting benefit from it by using it, or through sale, if we can't sell it, the asset should be written down to its fair value and an impairment loss recognized. So the example given in the PowerPoint is, let's say a computer manufacturer paid a high price to acquire some specialized production equipment. If new technology comes around that renders the equipment obsolete, it may become apparent that the equipment is worth less than what it's being carried on the books at. So in that case, the asset will have to be written down to its fair value and an impairment loss recognized. So you would have to credit the asset, actually write the asset down to its fair value, and debit impairment loss, an account called impairment loss or something similar. So the only time you would do this, because that seems to be in violation of the cost principle like we talked about before, this is what you would have to do in the event that a plant asset you own cannot be used anymore, and it can also not be sold because of obsolescence or something happened to it. So in this case, pretty much your only option would be to just keep it or to salvage it, dump it in a salvage yard. Not even if you're not even able to sell it, maybe just throw it in a dump somewhere. But in this case, you'd still have to adjust its carrying value on the books to its fair value, if any, and then recognize that loss. Now, lastly, MACRS, Modified Accelerated Cost Recovery System. So most businesses use MACRS, which is a depreciation method, for their income tax returns. So this is beyond the scope of our class, but it's important just to mention MACRS, that this is one of the commonly used methods when it comes to completing tax returns. So this is a little bit more complex than the other methods. So I just want everyone to at least be aware of this method, which is really common for income tax returns. And depending on what kind of asset it is under this method, how those assets are depreciated will be dictated under this system.